Hello, I'm Kelly,
And I'm Tiffany.
and we are your revenue insiders. Today, we have the wonderful James Newell joining us. Thank you, James, for joining us. We're going to talk about all things IPO, M&A, specifically about the recent announcement from Smartsheet on going private. So, James, for everyone in the audience who has not met you, could you give us a little background on yourself?
Yeah. Well, in my day job, I'm a venture capitalist. I work in Seattle for a firm called Voyager Capital, and we focus on investing in early stage B2B technology companies, mostly ones that are building within, call it the greater Cascadia region, states of Washington, Oregon, Western Canada. But relevant, I think, to the topic we'll address today, early in my career, I was an M&A investment banker, and so spent a lot of time in and around software transactions and kind of the rise of the private equity industry and how private equity started coming into technology markets. And so did that for a number of years to start my career, and so have a little bit of perspective in addition to what I see in my current job as a VC.
You have such an impressive background. He also did not mention that he is an expert soccer coach.
True.
So that's an important fun fact here for everyone to know. Tiffany and I actually have kids similar ages to James's boys. And yes, you are, what I hear, a very excellent soccer coach.
Nope. I'm just a guy running around who knows very little about soccer, but our league is so well organized that they bring in actual Europeans who grew up playing the game to do the actual instruction, and I just stand there with a stopwatch and tell
Oh, good. Okay.
run
Okay.
off and provide copious amounts of encouragement so everybody has a
That's important.
The number one thing you can do in parenting and business is just copious amounts of encouragement. I think
that's basically my job as a VC is to support founders and founders and 6-year-olds. They both require tremendous amounts of encouragement.
Absolutely.
So getting to the Smartsheet news, recently Smartsheet announced its acquisition by a private equity firm. So Blackstone and Vista Equity Partners made a deal with Smartsheet to acquire them for approximately $8.4 billion. They're looking to accelerate their growth, is what the announcement says, and leveraging their resources and expertise from Vista. They've done this with other companies in the past. I think in a lot of the tech space specifically, when people think of outcomes, they think IPO. Like that tends to be where you're going. And I imagine from a VC capacity, you often think IPO is an end goal of one of the things that you're working towards. I'm curious, with your background in M&A, like what are your thoughts on the different benefits of a private ownership model like this versus an IPO or a public model?
Yeah, well, Smartsheet or really any public to private transaction is just another stage in a company's life cycle. And so you heard me describe earlier, I'm an early stage investor. It really is a different risk profile, a different stage in the company's development. We're thinking about the company differently, and we really are thinking about growth. And then eventually, as you said, we all aspire to this idea of having an IPO. And as you know, the IPO window has been closed recently, and so there actually hasn't been a lot of liquidity coming into the innovation markets through that. And so into the breach has stepped the private equity industry because they have a tremendous amount of capital. And increasingly over the last kind of 10 years and maybe starting a little bit earlier than that, you saw a growing level of sophistication for those buyers and understanding software-based business models, how those companies become very valuable, and then a playbook you can run after an acquisition to improve the performance of a company. And so as VCs, we all want to see IPOs, but private equity has become a really viable alternative to drive liquidity in great companies, particularly as they get into the later stages of the company's life cycle. And so it doesn't have to be IPO or bust. There are certainly other options out there.
So Tiffany and I have both been through IPOs, obviously, when the market was a little bit better and more ripe for IPOs. But curious, when you think about the metrics that you care about today, how are they different than the metrics maybe that we care about when we're trying to go IPO? Is there anything different, or are those really the same?
Well, I mean, there's the IPO window is really a description of the profile of the metrics of a business that the public markets are willing to accept.
Yeah,
And so when there was a massive liquidity bubble and so much money was chasing growth assets, the IPO window was wide open because what a company needed to look like had a, I don't want to say lower bar, but it was just easier
it did.
to,
Yeah,
to paint a growth story.
that's a fair description. Yeah.
And so right now, the IPO market has been essentially a gatekeeper on keeping lower quality assets out of the public markets. It's a little bit outside of the sort of direct context of what you're asking, but this SPAC phenomenon that we saw, special purpose acquisition corps, allowed some literally ridiculously low quality assets to get into the public markets. And so right now that window is closed because the bar to get there is really high. And the metrics that people are paying attention to kind of fall into two categories. One is this a high enough quality business in terms of repeatability and forecastability of what you might look like over your next 6 to 8 quarters? You need to be at a certain scale. And so these are like check boxes that public investors will look at in terms of, is this a high enough quality public company? Usually related to profitability and growth and scale. The other bucket that people are paying attention to is, okay, this is a company that is that checks all of these boxes. Now, how do those metrics apply to how we're going to value the company? And so the other reason why we aren't having a lot of IPOs right now is that there's a lot of at-scale private companies that raise at very, very high valuations, and the public markets are saying, look, your multiples of those metrics are half or 40% of what they were in 2021 when you raised that. And there's people in those cap tables who don't want to take their medicine yet. And so we have this glut of decently scaled SaaS companies that are just kind of bumping along, that can't get public, and will eventually need to find ways to get liquidity to people who've worked there or people who've invested in those companies along the way. And it'll take a long time, and it'll be messy, and there'll be some broken hearts associated with that.
So when you talked about the journey from that companies are on from a maturity level, and IPO is one of those, like early growth phase is another. I think what kind of like highlights for everyone's what's unique about Smartsheet is the move from IPO back to a private ownership. And a lot of people that have been in their careers for 15 years or less are used to that liquidity bubble that you mentioned. And so not only is the stagnant nature of IPOs a little bit off for everyone, but this move back to private equity, I think, comes as a surprise to those that are earlier in their careers. I'm curious if you have any thoughts on that maturity journey. Like, what would be the motivators for a Smartsheet to want to move to private equity from the public markets when they took advantage of that liquidity bubble initially?
Yeah, it's a really great question, because I think the attractiveness of going public tends to wax and wane. And I think we saw 12 or 15 years ago, the small IPOs disappeared and private companies started saying private much longer. If you think about where Facebook was as a private company and the scale that they got to versus Microsoft as the generation before, there was lots of the iconic companies today went public at sub-billion-dollar valuations, and you would almost never see that now. And the really iconic companies, the larger companies, all that value is being created in the private markets, which was not the case before. Now, the benefits, of course, of public ownership are many, but the most important one is that, like, everybody wants liquidity. Your employees who work there want liquidity. Your investors want liquidity. But often these founder-controlled companies, which many technology companies are, they don't want to give up control of an organization. And so sometimes going public is really attractive, sometimes it's not. And it really does depend on who's in a leadership position within those companies in deciding when is the right time to go public. One of the drawbacks of public ownership, there's a few. There's a ton of compliance costs associated with running a public company that I'm sure you're familiar with. But another one is just that you end up with a really diffuse set of owners, and it's hard for owners in a business to affect management change, even if the leadership of an organization is objectively poor. And we can all cite examples of poorly performing CEOs who just sort of hang out and make tremendous amounts of money, even though their job performance is objectively terrible. But it's really hard to create a groundswell of public market investors to actually influence a board to actually fire a CEO. It's really challenging to do that. So you end up with a lot of public companies that don't end up with good leadership, good management, that can recognize challenges and move in a really nimble way. An underlying part of that is the fact that you are on a quarterly reporting cycle, and you end up with lots and lots of short-term thinking, and you can't, even if you know what the problem is, even if you know how to solve the problem, it's really, really challenging to convince the market that the bets that you're making today, which might have an impact on the short-term performance of the business, are going to pay off in 18 months. You can do that as a private company, but you can't do that as a public company. And so in the case of a company like Smartsheet, they probably feel like there are changes to their business that they want to make over the next, call it 2-3 years, a different time horizon than they can, then they'd be able to execute in the public markets, where somebody would say, look, you didn't hit your growth target, or we don't like your guidance for the next quarter. You're down, 25%. Then all the employees are starting to check their 401k, refresh, and you end up with really, really messy morale problems internally.
Yeah.
Oh, interesting. Okay, so as we think through that, a lot of our listeners are working go-to-market teams today. So I think the question that they're all going to have is, when a company like Smartsheet goes private, what would you expect to see from go-to-market changes and motion changes internally? Do you have any thoughts there?
Yeah, well, it was interesting when you characterized at least the public statements as to the benefits of why this private ownership. You said that they want to reignite growth.
Yeah.
Because that runs a little bit counter to the typical kind of private equity playbook.
Yeah.
Which is much more often about efficiency rather than hey, we're private equity.
Totally.
We're going to bring a big checkbook and increase the burn. That's sort of the purview of the venture capital model, where you're taking money on in order to increase burn. That's not generally what we see here, and in fact, in many of these private equity transactions, though I don't know about this one specifically, they're often doing it with leverage. And so they're actually levering up the business and trying to shrink the amount of equity that they bring in, increase the amount of cash flow of the business to pay down that debt, that ends up giving the investor a bunch of leverage on the dollars that they're putting in. So there's some financial engineering that's often associated with this. And as a result, anything that they can do to increase cash flow is typically where they're focused. I would say the most common way that this would affect folks on the go-to-market team, there's probably two. Number one, they're probably going to look for efficiencies across every part of the organization. And so this isn't necessarily a motion change, but there's going to be somebody who is taking a very hard look at who is a producer in every single function. And so you're going to see, who knows, maybe territories consolidate, maybe a very hard look at who's actually hitting quota, or who is performing by whatever KPI metrics that they use to track those groups. And people need to be aware of that is going to receive a ton of scrutiny. The other is often what we see in a transaction like this, and in particular when really, really large mega funds are involved, folks like Vista, is they'll buy what's called a platform asset. And in this case, I think the expectation is that Smartsheet would be a platform asset. And so, really, what they're trying to do is they're trying to buy one company and then bolt on other product adjacencies. And so, if I was a salesperson at Smartsheet, my expectation is that some of those folks who are partners today, we maybe have a co-sale, we maybe bring them in on certain deals. Some of those are going to be products I'm likely to be selling 2 years from now,
Interesting.
because you're going to end up bringing a bunch of that stuff in house, and we can acquire this great product that our customers love, but they have terrible distribution, and we're going to be able to bring that in and drive efficiencies as we bring that into our platform.
Yeah, it's super interesting. Kelly's talked about all of her M&A experience before, and I think that if you think about the Smartsheet acquisition as a platform asset play for those PE firms, then you almost get to have the experience if you're in like a go-to-market ops role of like getting through some M&As under your belt, but in a totally different capacity. Like I've been through PE acquisitions before. We went through one several years ago where we were 3 companies acquired at the same time by a single PE firm.
Mm-hmm.
And it's a very different motion. It feels different than other types of M&A. And so I think it'll be a unique experience for those there at Smartsheet. I do think, though, you said it earlier, my mind goes to when you hear of a PE buyout that it's like they're going to shrink things. They're going to shrink your, redundant roles. They're going to look for efficiencies. They're going to shift the vendors that you're using to the ones that they have already like really great MSAs in place with. But as you said, the recap and what you're reading and what they're putting out is it's a growth move. And I know being in private through IPO and at a privately held company now, you get so much more freedom for growth when you're privately held. Like you're not beholden to the street. So I'm curious to see like what signals we could start looking for from Smartsheet to see if they're truly capitalizing on like growth and innovation as their next step, or if we'll start to see them shrinking.
Yeah, I don't know which direction that they'll go. I have a hunch that they will that they'll be skinning down some of the teams. I mean that
Yeah.
it would be I think it would be foolish to assume otherwise.
Yeah.
But they're not. This isn't a sort of depreciating asset, and they're just going to be running it strictly for cash flow. I mean, that'd be disappointing as somebody who cares about the sort of Seattle tech ecosystem. Like I do, I'd be really disappointed if they put this thing in reverse and just ran it for cash flow to pay down a giant debt load. I don't think that that's the case. That's not really how Vista runs. And it's what's interesting to me is that Vista used to own a business called Wrike, Wrike, which had a very similar product. It's actually a competitor, and they sold it in 2021, I believe. So they top ticked asset prices on a very similar asset, some number of years ago, and so I'm sure there's a lot of different stakeholders in a company of this scale, and there's I have no doubt this is an all cash offer, and so shareholders say, what was it worth before this information leaked? $40 a share, and what am I going to get paid? 58 or whatever the number is. Great, I'll take the higher number. So
Yeah.
shareholders are going to be really happy. But as they were representing this transaction to the existing management team, they come with a case about, hey, here's how we're going to create value, and without a doubt, a meaningful amount of the sort of thesis that they presented was informed by what they did with a very similar business called Wrike, which I think they sold for like 12 times revenue, a couple of years ago. Now, asset prices have come down substantially, but from their point of view, they're probably saying, look, we sold Wrike for 12x, we'll buy this for 6x. And if we can get that same multiple expansion, in this business as we continue to improve it. This should be a really, really great transaction where we have tremendous domain expertise.
Absolutely. So we're seeing this play out in the news. There's obviously other companies like Nordstrom, like DocuSign, where there's rumblings of they're considering going private as well. Do you expect we're going to see a lot more of this?
That's a really good question, because I suspect the answer is yes. I don't think that the private equity trend, in terms of the size and scale of, or the percentage of total exit volume that they're generating, I think that probably only goes up. We have entered a slightly different era of antitrust, which has made it very difficult for large acquirers, particularly in technology, to make meaningful acquisitions. When I was doing M&A transactions, now almost 20 years ago, HSR was just a check the box. You just had to wait a couple of weeks, and nobody gave it any thought. And now it's a really meaningful consideration if you're dealing with larger organizations, and that takes a tremendous number of really impactful acquirers off the table. That's part of the reason why private equity has become more important. The only reason I was hesitated at all is that the private equity space broadly, because the IPO window it has been closed, it just hasn't been that. It's just not returning a bunch of liquidity to limited partners, and eventually limited partners, the people who fund this space in general, eventually they turn the tap off because they need money going back into their endeavors, because they have initiatives to support, grants to write, all of the things that trusts, foundations, endowments support. Like, they have real cash needs, and the industry needs to pay that back before we can continue to grow the broader private equity asset class in general.
So we have this Smartsheet news and maybe this pending move towards more private equity acquisitions as liquidity stays tight. We also heard from the Fed they are lowering interest rates, at least here in the US, by I think it was half a point. So there's a lot of factors moving around the liquidity and maybe how people make their money. Is any of that shifting how you look at things from a VC perspective, or how you measure or assess new opportunities?
Well, I mean, isn't every investor a better, smarter investor in a low interest rate environment? I mean,
Yeah.
it sort of ends up working out that way. Look, in my world as an early stage VC, you really can't make your day-to-day decisions in terms of outlay of capital based on what you think the exit environment or the liquidity environment is going to look like 8, 10, or 12 years in the future.
Yeah.
So it doesn't affect me in sort of that day-to-day way up till the point where we're looking for an exit for one of our companies. And that looks very different today than it would have in 2021 when asset prices were overinflated. They just were. So the short answer is no. The cycles that we care a little bit more about are waves of technology and what's happening and how innovative things are in terms of disruptive technology. And then the willingness and risk tolerance of founders to leave companies like Smartsheet and go start their next opportunity because the private equity firm laid them off, or they don't like their new private equity overlords, or whatever it is that causes them to finally push themselves out of the nest and go start it in Austin.
Okay, so final question for you, James. Have you seen a company that should have stayed private, or a company that did go private but maybe shouldn't have? And what was the outcome of that?
Well, I mean, just to
you don't have to name any names. Throw anyone under the
I'll
bus.
I'll name literally every SPAC, every company that went SPAC.
Good point.
Should be a private company. Those were not ready. And I have a friend who's in the public space, and I told him, you need to set up a short SPAC fund. like just short every single SPAC
Yeah.
that comes out. And we laughed about it over beers one night, and I like have intense regret that like we didn't both quit our jobs to do a short SPAC fund.
Yeah.
Because it was clear that it was just all of the low quality assets just getting packaged up. So all of those companies certainly should have gone private. I don't think that there's it's hard to run the counterfactual on like a different capital structure or ownership and governance structure would have led to necessarily a better outcome. I think you can probably do it either way. It's probably much more likely that the companies where that's most obvious are ones that got over levered and ended up, healthy businesses with an over levered cap structure. And you saw this a lot with a lot of retail companies that are like mediocre businesses, but they got levered up by private equity buyout firms and ended up going bankrupt, even though there probably is a reasonably healthy business in there, but they were failed by their investors who have a massive incentive to take risk, and that ends up wrecking in some cases wrecking an iconic company, in some cases causing massive layoffs. Because they just pushed it too far down the risk spectrum.
Well, thank you so much for joining us today. Super interesting topic, and I'm sure we will have you back to talk about other things because you're a wealth of knowledge in this space, and we appreciate you joining us.
This was fun. Anytime.
Yeah.
Thanks, James.
Thank you for tuning in to the Revenue Insiders. We hope you've enjoyed today's episode. If you did, we'd really appreciate it if you could take a minute to leave us a review on your favorite platform. Your feedback helps us reach more listeners. Thank you.